Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is a true oil and natural gas expert, having worked over 3 decades in the sector. He's a former senior executive at Hess Oil, specializing in mergers and acquisitions for many years over there. He's the president of the Energy Prospectus Group. They cover a lot of oil and natural gas stocks, the larger independent producers in the Sweet 16, and also some of the small cap companies in the Permian Basin, oil, natural gas, liquefied natural gas, and Canadian oil and natural gas energy producers. Dan Steffens, thank you for joining me again.
Yeah, thanks for having me. Interesting times.
And Happy New Year's to you. Excuse me.
Yeah, Happy New Year.
And Happy New Year to our listeners. We're recording this interview on Monday, January 20th, 2025. The West Texas Intermediate oil price, it was range bound for the last 9 or 10 months, Dan. It was on the lower end of the range when it got into the mid 60s at one point. It's rallied quite a bit lately. We're just under $77 a barrel West Texas Intermediate. I want to get your thoughts, though, on the sentiment in the sector, though. I'm getting comments. I interviewed another oil and natural gas expert similar to you, Josh Young, oil hedge fund manager, last week. And I was just getting comments under there like, why are you saying anything nice about oil? Why are you talking anything about oil? Do you think that the oil market is close to a bottom with sentiment and that the OPEC is working on balancing out the market with supply and demand?
Well, the first quarter, the winter period is, once you get past the holidays, is the lowest demand period of the year for transportation fuels. I mean, we're having this polar vortex, or what do you even call it now. Well, guess what happens? People hunker down. They're not driving around in the snow and ice. Now they're consuming more home heating oil, but fewer and fewer homes heat with oil each year. So once we get into the springtime and spring break and the weather gets better, just because 90% of people live in the northern hemisphere and we like to travel, you're going to get an increase in transportation fuel, so it'll get up. But I think there was also, when Trump was elected, it was I call it fear of drill baby drill, and I think that fear is greatly exaggerated. I don't think he's going to be able to do much about it, and that's why I think the oil price has, gone from below 70 to the upper 70s. Just last week, I think we touched 80 for a while on WTI. It's pulled back a little bit. And one of the reasons it pulled back, the price you see is the front month NYMEX contract, which when we're talking here, it's the February 25 contract. So those paper traders, they cannot take physical delivery. So they have to close their long positions. So you're kind of getting here we are, the markets are closed, but the commodity trading was open on Martin Luther King Day. And they both pulled back a little bit. It's because these longs, paper traders have to close their positions. And so this is kind of expected. But, I've raised my oil price I'm using in my forecast models. I was using 75 average for the year. I've raised that to 77.50. And the companies are pretty profitable at this. But the real upside, I think, and where I think Trump's very bullish, is for the natural gas producers.
Okay, so before we talk about the natural gas opportunities, and I agree with you, I think natural gas, especially liquefied natural gas exports, natural gas pipelines, the demand side of the natural gas market for liquefied natural gas exporting the United States to Asia, European Union to diversify away from Russia, all these data centers that the big technology companies are investing in. I think that's a new demand side of the equation. I'm seeing research reports that are projecting base case 15% compound annual growth rate, the largest growth rate of any industry for these data center build up. But first, I want to ask you about the oil market and trying to get some type of balance. I've seen oil bearers say that if the Saudis weren't cutting production, the oil price would have crashed to $40 or $50 already. I disagree with them. Also, let's not pretend that the oil market's fully a free market, because OPEC still has a lot of control over maintaining supply and demand. Do you think that the industry is getting more capital disciplined, that we're seeing less drill, baby drill, uneconomic oil production in the Permian Basin, that the industry is going to be more capital disciplined with the amount of drilling that they do?
Yeah, the public companies, which are the main drillers, the main producers, they're under a lot of pressure to pay dividends, buy back stock. None of their investors want drill baby drill again. And it's a good thing. I mean, they've cleaned up their balance sheets. They've paid off a lot of debt. They're in much better shape financially. But also, what's so much difference between now and in Trump's first term, they were going to drill baby drill anyway. The price of oil was high enough, 80 to 100. They needed to ramp up. There was kind of a shortage, and the U.S. needed to ramp up production anyway. So they were going to do it anyway. It really didn't have that much to do with Trump. It had to do with the prices and the fact that the technology was fairly new on horizontal drilling and these targeted frac jobs and stuff, much better completion methods. And so they were needed to drill to hold the acreage that they had leased. So now pretty much all the tier one acreage is held by some production, and these companies are not under a tremendous amount of pressure to just keep drilling new wells. They can. So it's changed from we got to go. We got to hold this acreage. We got to buy more acreage and everything. And now they control it so they can slow down and treat it more like a long-term mining business. It's a much different business than it was 8 years ago.
Okay, so you think then with the recent acquisitions, what ExxonMobil closing on Pioneer, ConocoPhillips making a large acquisition, and then what Diamondback doing an acquisition, I think there was quite a few others. There was approximately 250 billion of mergers and acquisitions. A lot of those were Permian companies in the last 2 years. You think then that there will not be rapid production growth going forward despite all those acquisitions?
No, I don't. I was on an industry panel a week or so ago, and the conclusion that everybody on the panel agreed that U.S. oil production is only going to increase by 200,000 to 300,000 barrels per day this year, and it's probably going to peak. It may have already peaked. Now, with Biden's, recent decision to make offshore drilling off the East Coast, the West Coast, and a third of the Gulf of Mexico, and some good places in Alaska, I don't see any way that U.S. production can really grow unless, Trump can reverse some of that stuff. But, they're going to, if the price goes up and it's economic to do, the only way I see them increasing their drilling programs is if the price goes up, and they're not going to drill it. They're not going to accelerate drilling to lower the price. That would be stupid. And now on the international thing with OPEC plus, as long as they can keep their act together, and there's a lot of geopolitical risk here. First of all, there's got to be some resolution of the war between Ukraine and Russia, and who knows how Trump's going to deal with that, lower the sanctions. But the sanctions really didn't take much oil off the market anyway. Now, Trump has a much better relationship with Saudi Arabia than Biden did. And so he can probably work out something with them. Maybe they will put more oil on the market to lower the price and help him out a little bit. But then what's he going to do about Iran? They publicly come out and said they're going to go back to maximum pressure on Iran. I think, Iran has really been put on its knees. I mean, Israel's, wiped out Hamas. They've wiped out or pretty much definitely reduce the risk of Hezbollah, the Houthis. They've taken care of them. And if they can cut off Iran's money supply, you're going to really reduce the risk of terrorism and advances by Iran in the Middle East. And the other Middle East people like Saudi Arabia, they want that to happen. So there's a lot of moving parts right now. There's a lot of noise that impacts the oil price. We definitely have adequate supply right now. So I just see oil staying in this, hopefully the $75 to $80 range. I'm using $77.50 for that reason. I believe that's kind of the right price for oil now. And the companies are pretty profitable. They're pretty profitable, and especially if they can get a little kicker from their gas production.
Do you think that the Saudis would cut production further or pressure the rest of OPEC to do further production cuts, or at least maintain the production cuts that they have in place? If the oil price, let's say it weakens a little bit, there's a recession, let's say the oil price drops below 70, do you think the Saudis would say, this is not a good enough price, we're going to cut production even more?
Yeah, they could. And I think they would be stupid to oversupply the market and push the price down to $50 or $60. They're not going to do that. And they don't really want a $100, $120 oil because they know that'll mess up the market too. They're perfectly be happy with stabilizing in the $80 a barrel for Brent range, which is where it is. I mean, I'm looking at the closing price for Brent today, and it's $80.15. I mean, they're happy with $80 barrel oil.
Which companies in your Sweet 16 are some of the lower cost producers that can still have good profit margins at the current oil price?
Yeah, I really like Crescent Energy, and I like them more because of their production mix. They have quite a bit of oil of gas production, and they also have the flexibility to move their rigs between their oil and their gassier areas. I like Devon. I think Devon looks really cheap now. Of the bigger companies, it's one of the bigger ones, and it's trading at about a 40% discount to my valuation. Of course, EOG and Diamondback look really good. They're solid companies, and they got a lot of high quality acreage for sure. Ovintiv, which used to be in Canna, that's O symbol OVV. They got a very good production mix. They've done a tremendous job of cleaning up their balance sheet, which is in much better shape, and they have a lot of running room, and it's a pretty big company that you don't hear that much about. Ovintiv, it's OVV.
And these oil companies are still profitable, right? They're not like
Oh yeah,
borderline break even. They're still pretty profitable.
no, they're very profitable. They're all generating positive cash flow, free cash flow. The only company I follow that does not pay a dividend is Antero Resources, which I added to the Sweet 16. It's pretty much a pure gasser. They do produce a lot of natural gas liquids, NGLs, and that's another thing. This cold weather in the Midwest has significantly increased propane prices. I think they're about 25% higher than they were a year ago with the mild winter that we had. And this cold spell that we're having right now, like it's getting down to like 20 in Houston here tomorrow night. And when you the middle third of the country still uses a lot of propane for space heating and cooking. And if you get that price, it's really going to help Antero Resources. It doesn't pay dividends, but it's got a lot of upside, and it has direct access. It can get about 70% of its gas directly in what's called the Tier 1 area of Louisiana. And in there, they pay a premium, like a 20 to 25% premium per MCF for their gas there, because that's where they're opened up that big Plaquemines Venture Global facility that just opened up a couple months ago, and they're paying premium for their gas there.
And for our listeners out there, that's the hot company that's about to go
Mm-hmm.
initial public offering. I don't think they've gone IPO yet. They're about to. So if you want to read up on that company, Dan does not cover Venture Global yet, but their
Mm-hmm.
prospectus is out there. So if you want to learn about the company, I think they're headquartered here in Northern Virginia, but all the
Mm-hmm.
assets, like Dan said, they're building this, or they already have built this massive liquefied natural gas export facility. I think they have a lot of contracts too.
Yep, it's 2 BCF a day, and I think their gas is totally contracted.
Well,
They're
you
really
basically have to, unless you're insane. If
yeah.
you're going to spend billions of dollars of shareholder funds and debt to build a liquefied natural gas export facility, you better have some bunch of offtake agreements done. You're
Yeah,
seeing
they
this
all
with
do.
what? Well, you're seeing this with Woodside too. They went and bought what the Tellurian project,
Uh-huh.
the Tellurian project, and they're already negotiating all these offtake agreements with Japanese utility companies in Europe.
Yeah, the upside in the global gas market is tremendous for these U.S. based companies because the gas price in Asia and Europe is like $14 per MMBTU, which compares to $4 in the United States. So if we can get these LNG export facilities online, they are extremely profitable. Now it depends on where the gas changes hands. A lot of the profit does go to the shipping, tanking with the tankers for it. I think so. You really need to know how the things are structured, and I think the one that Global Venture Global is built down there in Plaquemines is probably getting a big chunk of that profit. So anyway, there's huge profit margin where you can buy gas for 4 in the U.S. and sell it for 14 in Asia or Europe.
Well, the main one was Cheniere Energy. So
Yep.
that company was viewed almost a penny stock. It was sub $5 back in 2008, 2009, and it's hundreds of dollars a share. I haven't looked at the company recently, but that's like the best pure play for liquefied natural gas exports, and they have just massive facilities and a ton of offtake agreements.
Yeah, they just are starting to ramp up Train 3 down in Corpus Christi, as where they have a big facility. Now, if you're looking at the companies for gas production, be aware that the Permian Basin companies do produce a lot of gas, but that area is still going to be selling their gas in really deep discounts because there's not enough pipeline capacity. Those wells are drilled for oil, and they do produce a lot of rich gas that has, a lot of NGLs in it too, propane, butane, all that, but they don't have enough pipeline takeaway capacity, so they're stuck, and they cannot flare. It's against the law
So
to flare now, so they have to give it away.
So even the Matterhorn pipeline, which just came online, what
Yep.
is that, Enbridge or One Oak? So even the Matterhorn pipeline is still not enough that we need additional natural gas pipeline capacity to come online soon?
Yeah, it helps the central area a little bit, but it's they're still going to be a deep discount. Hey, the last time I looked at Diamondback Fang, I think their net price after gathering and processing fees was like 70 cents. So that compares to like $3, an MMBTU. So they're not hardly getting anything off their gas sales now. So if they can just get get it up to $1.50, that's a big. They produce a lot of gas, but they're drilling those wells for oil, not for gas. So
So it sounds like there's a huge infrastructure opportunity, investment opportunity for a natural gas
there is.
pipeline company to take either that cheap natural gas in the Marcellus or Utica shale for EQT and get it down to the data centers here in Northern Virginia. It's only about a state over, or to get that natural gas, like you said, in the Permian Basin and
Mhm.
get that to a liquefied natural gas export facility. That sounds like big, big profits.
Yeah, that's where Team Trump can really help the industry by fast tracking more infrastructure stuff, pipelines, processing facilities, the LNG export facilities, and I think they're going to be looking at all that. This guy Chris Wright, that is going to be the energy secretary. He's a superstar in the industry. He owns Liberty Oilfield Services. They're really a good company, and he knows the industry well. And he's going to be a great advisor to Trump. And they see the upside. We have a trade imbalance with the rest of the world. Exporting gas is going to be a way to help balance the U.S. trade.
Well, we can't fully balance it, Dan, because we have the
Yeah,
world
no,
reserve currency. So that you have Triffin's dilemma.
yeah, you got a problem. But
But
anyway,
but I get your point though. I mean, like I've seen this guy's the current or the Trump appointee for the Secretary of Energy about his like energy investment philosophy, and he basically said in the presentation we need to invest across the board. So he's like clean coal, yes; nuclear power, yes;
yes,
natural gas, yes;
yes.
liquefied natural gas, yes. He's basically like we need to invest in all of these things.
Yeah, there's no way we cannot meet the electricity demand that's coming from AI, just energy demand in general. You're not going to get rid of fossil fuels, period. They're part of the solution, and especially natural gas. Natural gas is the clean hydrocarbon. Now, maybe in the long run, uh, electricity from nuclear power plants, fine. But the problem is we don't, if you cannot switch everything to run on electricity because we don't have the material to build out the grid. It's impossible, physically impossible. So we can't get rid of internal combustion engines until we would have a massive upgrade in the grid.
Well, the nuclear power plant that just came online in Georgia, that
Mhm.
was, I think, only supposed to cost about 10 billion. And I think it cost
Yeah,
over 20 billion to build, and there was many years worth of construction delays. So it didn't come in on time and on budget. It cost many billions of dollars more, and it just shows you that here in the United States and many other developed countries, it's a pain in the butt to even build one nuclear power plant.
Yeah, I work out with some old guys that meet over at LA Fitness every day, and one of the guys is an expert in that area. He worked for a company that did a lot of engineering, like for Fluor Daniels and stuff like that, that built these power plants, the nuclear plants. And he said there isn't a nuclear power plant built that didn't overrun its budget by billions. I mean, they take forever. Now, these small modular things, and I was talking about that. He goes, yeah, maybe on some areas that's going to be maybe one specifically for an AI data center or something, but still you got to get them approved, and nobody wants to live near a nuclear power plant. So it's just so much easier to right size a natural gas power plant for an AI. And, the one company, Solaris Energy Infrastructure that I follow, symbol SEI, when they announced in July that they were going to get into that business, that stock has gone up 300%. And they're doing it right now, and they're generating significant profits right now. This is not some, pie in the sky thing that's going to happen in a couple of years. They're doing it right now, and they put out a press release a couple of weeks ago that said that they're getting more and more orders. They can't keep up with the orders. It's
What are they doing specifically at the
they're
data centers?
they what they do is they have these modules that are like the size of a freight car, and if depending on the size, they can right size it for a data center. Now, these are not maybe the mega data centers like what Elon Musk is building, but you can put 5, 6, 7, 10 of these things hooked together, and just think like their oh, they have like jet engines almost in them. They're not like a Generac next to your house that just runs off natural gas. They're run off turbines. So, but you can right size them, and they can put them in pretty quickly. These things are manufactured. You just say, I need 5 of them, and then you hook them together, and in like 2 or 3 months, you can be up and running.
Okay, that's very interesting. So you did bring up Elon Musk, and for our listeners out there, I've talked a little bit about this, the Colossus data center. That's kind of the case study now, because now the data centers and the data centers going forward, it's looking like these things are going to be 100,000 GPU units or more per data center after Elon Musk and XAI built the Colossus data center with a new engineering design in record time. I think approximately 120 days. Uh, and they didn't connect to nuclear power, like Dan said. He negotiated natural gas pipelines directly to the data center. So that's reliable baseload electricity. I think it's in Tennessee. He got those
Hmm.
natural gas pipelines built. He also had to get like supercooling systems. They're doing liquid supercooling. So that's burning even more electricity as well.
Yeah, the thing that's going to save the data centers that are in Virginia is the fact that they're close to Appalachia. I know that EQT is talking to a lot of those AI data center people to supply them with the gas they need to do their power generation. So
Well,
anyway,
there's a huge
it's a
fight.
big
There's a
upside.
huge
It's a huge
fight.
upside.
Well, there's
Huge
a huge
upside.
fight because the governor, Glenn Youngkin, he wants the investment, like you said, he wants those pipelines built. He wants more data centers here in Northern Virginia. And then you have a lot of the residents that are Democrat in like Fairfax County and some of the others that are government employees, either for the state and local government or the federal government, and they don't want the data centers. They don't want their electricity bill going up. They're anti-fossil fuel. They're anti-data center. Although, because there's a lot of articles in the local papers here that they're putting the data centers in residential areas,
Hmm.
and some of the projections that like the electricity bill could go up enormously. I mean, already here in the state of Virginia, this is why the state of Virginia is the data center capital of the United States and arguably the world. 25% of our annual electricity usage is already data centers in the state of Virginia.
Yeah, you're the AI companies are multi billion dollar companies. They are going to throw the money at this. They're going to solve the problem. They have to. They have to, or they'll fail. They have to have the electricity. So,
Well, I mean, they have like Microsoft makes their money off Microsoft Office and their
yeah,
cloud computing businesses and their other stuff, but they're still committed. They said at least that they're going to spend $25 billion in 2025 on capital expenditure, investing into new next generation data centers and artificial intelligence. Amazon's planning on spending even more than that.
yeah.
So, I mean, like these companies have other businesses that they can use to subsidize their investments into this next growth sector.
Yeah, I'm just super bullish. This is just one of the 3 things that's happening right now that's really making me bullish on U.S. natural gas. And we've had the lowest natural gas price in the world by far. I mean, Europe, Asia, double digits, 10, 12, 15. During the very beginning of the crisis with Russia being cut off, they're paying $50 an MMBTU. I mean, and we're selling it for $3 or $4. We have $2 gas. Well, $2.50 gas is so unrealistic. There's no profit margin for the companies. So they're not going to build anymore. They're not going to drill any more wells and build the infrastructure they need unless they get $4 or $5 gas. So I think what's going to happen, step one was have the cold winter. We're getting the storage, that was a surplus is going to go to a deficit here by the end of January. Step two is the LNG export facilities ramping up like crazy. By March, we're going to be exporting 5 BCF a day more than we did a year ago. That's per day. That means additional 35 billion cubic foot a week of additional demand for U.S. gas. And then you got coming up close behind that is the AI data center crisis, that they need more electricity. And the only near-term answer is more natural gas-fired power plants. I mean, yeah, there's some nuclear part of that, a little tiny bit wind and solar, but the bulk of the solution to that problem is going to be natural gas-fired power plants.
Well, also for the nuclear power that's going to be coming on. I mean, Microsoft, Amazon, Meta, they already locked it up.
Yeah. Well, that energy panel that I was on a couple of weeks ago, and they were not, they were wide open for, saying that long term nuclear is the solution, but it's not the near term solution. And everybody on that panel was super bullish about natural gas for the next couple of years.
Didn't you say before we started recording that natural gas exports are going to go from what 14
Yep.
billion up to 39 billion? That's more than doubling.
Yeah. If you want to get a quick update on that, just go to Antero Resources website, and they have a presentation just on how quickly that LNG exports are going to ramp up. So in 2023, at the end of 2023, we had total capacity of 14.5 BCF, but the Freeport facility had a fire, and that took 2 BCF a day offline. So at this point, in the first quarter of 2024, we were exporting about 12.5 BCF per day. We're now ramped up to 15 BCF a day, and we'll be up to 17.8 BCF per day within a few months. When Corpus Christi is fully ramped up, we'll be at 17.8 BCF per day of export capacity. And it will remain full, as long as they got the ships coming in to fill up, they're going to be exporting it. And they're lining up down there to take it over to Europe and Asia because of the difference in the price. The arbitrage on this stuff is incredible. And then you got Golden Pass, which is Exxon's facility. That's fully approved. That's definitely going to be online by the end of 2025. And then there's, several that are fully approved, but there's a bunch of them that Biden put on hold, that there was the Biden pause. They weren't approved. Trump is going to approve every one of them, and he's going to fast track them, and he may be doing something for lower interest rate loans or something. He is super, super supportive of the increasing of the LNG exports.
Yeah, and then you also have Woodside Petroleum. That's Australia's largest oil and natural gas producer. They bought the Tellurian project, and they're negotiating the offtake agreement. So that construction is going to ramp up quickly. And then you have the one that's about to go IPO. So there's a lot of natural gas, liquefied natural gas export facilities that will be coming online over the next 4 to 7 years.
Yeah, and I just looked. There's 2 more that were on the list that were being paused of Venture Global. There's Calculus Pass phase, that's phase 1A, and then Plaquemines phase 2. Both of those were put on hold by Biden. They're going to be approved, and they're going to be 2026. So that company does have quite a runway of growth. So if they're going public, that would be one for your listeners to look into.
Yeah, they have some good timing, but with these initial public offerings, the insiders normally, when the lockup period expires, they want to cash out on their shares. We'll see if that happens. But long term, I agree. It looks like they have a potentially bright future unless the environmentalists try to sabotage and delay or cancel the project. Now, in terms of getting the pipelines, getting the natural gas from the Permian Basin or somewhere else to the liquefied natural gas export facilities, are we looking at some of the tried and true, the profitable pipeline companies like a One Oak and Enbridge, or are there other companies?
And the other one, Plains All American, looks very good to me. They cut their dividend because they had capital commitments, but all that's behind them now, and the stock was trading below book value. It's PAA is an MLP, pays a nice dividend, but you can buy the general partner is PAGP. They pay identical dividends, and the yield on that is 7 or 8%. And it looks really good. There's a lot of upside in the stock, and you get paid nice dividends to watch that thing ramp up. But they are heavily into the Permian Basin, one of the big carriers of liquids. One Oak is out there also. Enbridge, I think, is out there.
Yeah, Enbridge has been announcing that they're building a lot of pipeline capacity, I think, in the Permian Basin, especially natural gas pipelines. I'm kind of surprised that Kinder Morgan, Energy Transfer Partners, some of the larger MLP companies, that they're not getting into the natural gas pipeline from the Permian to the LNG export facilities yet.
Yeah, I don't know. Energy Transfer is a really good company. I'm not a midstream guy. I'm more of an upstream guy. So I've got a few of them in our high yield income portfolio, but that look really good. So.
Okay, I was going to ask about dividend growth and
Mhm.
exposure to these natural gas pipelines. So you mentioned One Oak. You think that One Oak's probably one of
Yeah,
the safer plays.
One Oak's really good now. It's run up quite a bit. It's that stock's kind of at a premium, but that's a first class company, and they've already said they're going to increase dividends like year after year, because they got a lot of their big capital investment behind them now, and they got a very clear path to a very high cash flow for the next few years. I think they said they're going to raise their dividend by 15% year after year until they reach a certain DCF level, distributable cash flow percentage, and they've got a long way to go before they get there. So they could be raising their dividend for 3 or 4 straight years. It's a
The
really nice
market
company.
the market has also kind of figured out that there's going to be natural gas issues and there's a lot of profit potential with the pipeline companies because what EQT and also One Oak have done very well the last 12 months, the shares have already run up substantially because the market has figured out that we're going to have to move the natural gas via pipeline to the places like the data centers and elsewhere and the liquefied natural gas export facilities.
Yeah, that's a lot of it. I think Trump's going to be real positive for all of the midstream companies as well. I mean, he's just pro industry, and you need the midstream companies like crazy. So.
But in general, though, you think that there's going to be less drilling then, even though Trump is saying, what drill, baby, drill, and he's probably going to approve more leases on federal lands. You think that the private sector companies are not going to actually drill. They're going to be more efficient with capital constraints.
Well, the private capital is because it's raised for tax reasons, for one thing, the deduction of the IDCs. So one positive there is Trump's not going to take away that deduction. They were worried that if Kamala got elected, she'd go after, that prize which they have. So I think that the private companies, U.S. Energy Development, some of the ones the conference I do up in Dallas is all private companies raising money for drilling projects. And they literally raised like a 1.6 billion last year. So they're still raising money, but, yeah, I think that if there's increase in drilling rig activity, it's probably going to be the natural gas producers. But again, they're not going to be doing that in the Permian. Now, over half the rigs drilling in the United States do drill in the Permian Basin because for one thing, it's gigantic. And number two, it still does have some very profitable stuff, even if oil's at 70. Now South Texas, which is the Eagle Ford, down there, it has got real good pipeline capacity right now. That's why I like Crescent Energy. The Central Oklahoma it's a much smaller area, but it has got some nice little companies in there. Devon's in there, of course. Let's see, a little company that I like in there is called Calibre. Calibre Global Energy. KGEI is its symbol, and it looks like a double to me. It's a small company, but they've announced some really good wells recently, and that always draws some attention.
Last question before I let you go. I want to ask you about the Canadian oil and natural gas producers, since
Yep.
you also cover those. Is that new pipeline capacity that's come online from what Calgary, Alberta, Edmonton area in Alberta to the coast in Vancouver area, so they could get a higher natural gas price in shipping the oil and the natural gas later? Are there any producers that are Canadian producers that are
Yeah.
benefiting from the pipeline coming online?
Yeah, they are. All the companies that I follow in Alberta, and I follow quite a few of the small caps in there. Oh, by the way, the U.S. stock market was closed for Martin Luther King Day on Monday, but the Canadian market was not. And a lot of the Canadians bounced back. They were sold off because there was this worry about the Trump's tariffs. I don't think he mentioned tariffs on Canada in his presentation today at the inauguration, and so those stocks bounced back 2 or 3%, all of them in trading today. And there's some great companies up there that are very profitable. Some of the companies that I follow have paid off all their debt. I like in-play oil is going to do real well. It's a little one. They produce about 40% on a BOE basis as natural gas. And if those gas prices now their gas prices have not gone up as high as the U.S. gas prices, but they will. They will eventually. They are also going to bring on an LNG export facility in a couple of months. This summer, they're going to bring on an LNG export facility, which should help debottleneck their natural gas situation. And this cold weather, it's cold up there too, but there's not that many people living in Western Canada, so it doesn't create, home heating demand as much as it does in the U.S. And their pipelines going south into the U.S. are pretty much full, so they need this export facility on the West Coast, and that'll help them. So.
That the oil price, so the oil that was trapped in the past, what in Alberta, they can
Mhm.
get that now to the coast in British Columbia,
Yeah,
and so that
their
tenor.
oil price went up like $6 or $7 a barrel when that thing opened.
Okay, so the discount used to be more than that at one point. I think it was almost
Yeah.
over
Oh
ten
yeah.
dollars a barrel.
Yeah. Well, I'm just saying there's still a differential, but the differential shrunk when
Oh,
that
that's
thing
good.
opened up. Yeah. Now the other thing is, there's been a decline in the exchange rate. It was like 74 cents Canadian for a dollar. Now it's 70 or 69. And a lot of these companies sell their oil under WTI contracts. And so if you have a strong dollar and then they convert it to Canadian, so they're getting more Canadian dollars for their oil and their expenses are being paid in Canadian dollars and they're not going up. So the exchange rate is really actually in their favor because they have WTI contracts.
And you've talked in the past about what Journey Energy Surge, I think, is another one
Yep.
you
Yep.
like, and then is Whitecap the other one?
Yeah, I took a hard look at Surge today, and man, it looks good. They pay monthly dividends, and there was some concern that they didn't have enough free cash flow, but they're going to have enough free cash flow. And they recently sold some non-core assets for $9 or $10 million. I mean, this is a small company, but they produce about 23,000 barrels per day, and about 90% of it is liquids. Really, it's like 87% light crude oil and 3% NGLs because the area they sold was primarily natural gas, and they've got a lot of running room. Now they're going to do a webinar with me on Thursday. The president's going to spend some time with me, about 30 or 40 minutes on Thursday, and I think that's going to draw some interest to the stock. A lot of our members own the stock. It pays monthly dividends. I looked at the dividend yield is like 8.8% based on Friday's closing price.
And that's Surge Energy, and that's owned by a lot of other oil portfolio managers, and kind of like Eric Natal,
Yes.
who's on BNN a lot, BNN and
Yeah,
Bloomberg.
yeah, yeah. Eric's really high on that company. The symbol is SGY.TO in the U.S. And let me give you the symbol's kind of weird in the U.S. No, that's on Toronto Exchange. Let me get hang on. Search. There it is. Okay. It's the symbol is ZPTAF in the U.S. and SGY.TO in Toronto, producing about fourth quarter production, 24,000 BOE per day, 87% crude oil, 3% NGLs, 10% natural gas. And it's got an area called Hope Valley where they're getting some very, very good results on multilateral wells. They go down and then they drill like 4, 5, 6. I think on one they drilled 12 laterals off the bottom hole. They're just open hole completions, and they're getting very good results. And these wells pay out in less than a year. I mean, they're strong results for that area.
And the valuations on Canadian oil and natural gas
Oh,
producers are way cheaper than U.S. ones.
super cheap. My valuation is $13 Canadian. It's trading for under 6 Canadian. And my valuation is just 4 times operating cash flow. It is free cash flow positive, has more than enough free cash flow to continue paying its monthly dividends, and it has paid off a significant amount of debt. The balance sheet's in very good shape now, and it looks good. Unless oil prices would just crash, it's going to look really good. And they've laid on some hedges that kind of reduce the oil price risk too. So it looks good. It looks really good. And it's got a lot of running room, like hundreds of drilling locations.
Do you think we'll see more mergers and acquisitions in the Canadian space, or are they not as aggressive as U.S. companies?
Not as aggressive. And frankly, I did M&A work for Hess. Some of these things are screaming takeover targets. Hemisphere is trading for below the value of just its proved developed reserves. In place trading at a very low deal. Surge. What's the other one?
Journey. I think
Journey,
you just started covering Journey.
Oh, yeah. Okay. There's another company up there called Spartan Delta, And Journey is in a joint venture in the Duvernay light oil play up there with Spartan Delta. Spartan Delta is the operator. I like Spartan Delta better, but that joint venture is going to be a really big deal for Journey. And they've announced the first two wells are really good wells, and they are going to drill like another 14 gross wells. Their share is only like a third of that, but they're going to drill a lot of wells in there, and they'll be ramping up their production. They'll be ramping up their proved reserves too. And Spartan Delta is a very highly respected management team. So that would be the one to look at. Look at Spartan Delta, and then you can, figure how that's going to really, really help Journey too.
Well, I would argue that in the S&P 500, the oil and energy sector is the cheapest because the profits and free cash flow for the larger companies like ExxonMobil and others are still relatively high, but the valuations compared to a lot of the other industries are relatively cheap.
Yeah, and you're not, there's no way Exxon's going to double their production or Chevron or anybody. I mean, they're solid companies and they pay great dividends. But if you're looking for, some doubles, triples, you got to go for these smaller companies, and you got to find the ones that have really strong balance sheets. They're generating a lot of free cash flow, and I call it running room. Within the acreage they have, do they have a lot of really low risk, high quality drilling inventory? That's what I like about Surge, by the way. It's really good, and In Place got like 300 very good drilling locations up there, and especially if the natural gas price improves.
Well, I think our listeners got some really good stock picks from Dan. Dan has excellent newsletters. I've gotten feedback from some of my listeners that Dan has made them a lot of money over the years with some of his stock picks.
Yeah, there's some interesting ones up there. And one of our members, a guy named Harry Van Neck, has started working with me. And Harry was the top economist for Shell. He's based in the Netherlands. And he really does some good work and has been a great help to me in finding new ones. I'm going to be adding, by the way, Peyto Exploration. We're adding that to our high yield income portfolio, and the dividend yield is 8.8%. And again, it is a solid company.
Oh, you're saying you have a former Royal Dutch Shell employee that's working with you now?
Yeah, he's retired from Shell. He's like 70 years old, but he got like 40 years experience with him. But his whole area was he worked in M&A. His title was petroleum economist.
Oh, that's interesting. I mean, like Royal Dutch Shell and BP, like they have a lot of losses from their investments. In solar, wind, biofuels, a lot of their ESG investments are enormous losses.
Yeah, well, we were talking about that offline when I was talking to him the other day. We did a joint webinar the other day, and he gave us his top 10. He follows 84 publicly traded energy companies, and he follows them closely. I don't know how he could possibly keep up with all that. I can't.
Yeah, that is a lot, especially if you're retired. I guess like you can kind of maybe program artificial intelligence to do some of that work now if you hire like a computer program.
Yeah, I've got 3 MBAs that help me. I divide them up, but we follow about 40 different companies, and I'm really looking at smaller companies that the Wall Street gang hasn't figured out yet. And that's where we made the most money.
Well, I think a lot of this natural gas, so I'm also bullish natural gas like you over the longer term, but I think like base case for a lot of these data centers, artificial intelligence, U.S. exporting liquefied natural gas, so the buyers diversify their supply away from Russia. Think all that you add up a lot of these other countries in the developing world still want to add infrastructure. You have India. India wants to add more electricity for their poorer neighborhoods. They're investing in infrastructure. So you add all these things up, and this is looking like a really good growth picture now for natural gas, especially with all these data centers and artificial intelligence.
Yeah, thank God we got it, because the U.S. has got massive natural gas reserves. We're blessed to have that much.
Yep, and natural gas benefits from nuclear power than taking so long to build one new nuclear power plant. So if it was easy to build these new nuclear power plants like in China or India, natural gas wouldn't benefit as much. So.
All right, man. Go ahead. I'm sorry.
Oh, I was going to wrap things up here, Dan. I want to thank you so much for your time. We've got the national championship football game going on a little bit later, so I know you're a big football fan. You play college football.
Yeah, I can concentrate on that now that the Texans have lost to the Chiefs. I can concentrate on college now. Anyway, coming to an end. Thanks a lot for having me on.
And if my listeners want to check out Energy Prospectus Group, how do they do so?
You can go to Energy Prospectus com, and we're out there. You could send me an email at dmsteffens, that's dmsteffens at comcast.net. And I tell you what, I'll send you a link to our last webinar, and we talked about like some really nice picks there.